there. And let's talk about the commercial vehicle space in terms of financing. We have the management of Sundaram Finance with us. Rajiv Lochan is managing director of the company, and he's joining us for a quick conversation on how the CV cycle performance is panning out. Mr. Lochan, thank you very much. Great to have you with us here. Thank you very much. You know, we've heard so much from different companies we speak with how things are picking up and things are on an up and up as far as commercial vehicle space is concerned. Could you put some numbers to that in terms of disbursements from your end in Q2 so far? How is that stacking up as compared to previous quarters?
Good morning, Prashant. Thanks so much for having us on the show. Certainly, as we get into the festival season, the mood is positive in general, as it should be. Over the last quarter, I think we've seen significant movement in different subsegments of the commercial vehicles. I think buses were, in a sense, the first to get off the blocks, starting with school buses and then subsequently staff buses and more recently route buses. That's a segment that, as you know, over the last couple of years has been quite muted given all the vagaries of the pandemic that we've had to deal with. So a lot of buoyancy in that space. Tippers have remained, I think, quite robust right through, and that story has continued through the last 2 or 3 months, I would say. The one that I think we track quite closely also is the haulage, and in many ways that tracks the economic activity within the country. Over the last 3-4 months, the activity has remained quite robust and steady. All indicators that I'm sure you track and we track, around diesel consumption, around e-way bills, around toll collections and so forth are all trending up in the right direction. And so that has reflected in the haulage growth as well. If I just unpack that one level, I think it's mostly been 2 drivers. One, replacement demand across all these, but also GST-related buying that some of the larger fleet operators have planned for and executed. So this past 2 quarters, I would say commercial vehicles is certainly on the upcycle. External complications, that are beyond the control of the local economy, whether it is sort of geopolitical complications, monetary policy actions by central banks around the world have an impact. But structurally, what we're seeing is a bounce back up on that upcycle of the CV space that we've been waiting for some time now. And there are clear signals of that happening quite systematically.
That was my next question, Mr. Lochan. Generally, when a CV upcycle starts, it lasts for about 2 to 3 years. At what stage of this upcycle are we in right now, if you had to sort of gauge the trend?
Yeah, we've been bottom fishing for a while, Sonia. And I would request all of you to please call me Rajiv as opposed to Mr. Lochan, which seems just too formal. But we've been bottom fishing for a while, and multiple factors have sort of compounded that over the last, I'd say, 4 to 6 quarters. My sense is we're probably at the early stages of the upcycle, which over the next 2 to 3 years, we should expect to sustain and continue. I expect that the dynamics across the various subsegments, buses, tippers and haulage might be slightly different as we go forward, as also the mix between replacement buying and expansion. So some of those dynamics might influence how long it lasts and how steep the recovery is. But to answer your specific question, Sonia, we're probably in the early stages of the upcycle that we're seeing right now.
Mm-hmm. How's sort of asset quality holding up, Rajiv? I mean, if you can give us some sense.
Well, asset quality has been improving quarter on quarter quite systematically, Prashant. And I think the circular from the Reserve Bank on asset quality, which came in November, has actually for us been quite a boon, because what that has essentially allowed us to do is to enforce the discipline of the fixed billing dates, as we call it, for repayments. And our customers have adapted well. Our people have adapted well. And on the back of that, the discipline of honoring the due dates is beginning to fall in place. We've seen consistent improvements in our own asset quality over the last 4 to 6 quarters, and that trend is holding up quite well. We're quite pleased with the best-in-class asset quality that we currently enjoy.
Okay. Any disbursement growth targets that you have for the full year? I mean, in the quarter gone by, of course, it looked exceptionally good year on year because of the low base. But what is the target that you can achieve by the end of the year?
Yeah, so growth is something that's not entirely in our control, Sonia, and particularly given some of the complications that we're facing, just given how the external environment is just now. What we tend to focus on is a lot more on market share, which we think is much more within our control and influence. And so our ambition is to retain our market share, particularly in the medium and heavy commercial segment, and in the retail commercial segment, which is intermediate commercials, light commercial, and small commercial vehicles, actually build our share to a double-digit kind of level is where aspirationally we'd like to get. There's also other asset classes in our mix, which gives us a diversification benefit. As we get into the tractor season now, tractors are a very important and interesting portfolio. We are seeing rural sentiment pick up quite nicely. And again, there we'd like to establish a decent market share. So our growth is in some sense imputed from the market share we'd like to get to.
Rajiv, what's your liability mix like? And, you know, rates are going up. I mean, tomorrow we've got an RBI policy where they will have to hike by, according to, you know, economists, at least by 50 basis points, and maybe have to do more later because of what's happening globally, not so much here. What does that do to, you know, cost of funds for you? And eventually, I mean, that'll seep through everywhere, margins, etc.
That's absolutely right, Prashant. I think the rate hikes, of course, are quite warranted given the inflation pressures we've seen. And, you know, our liability mix tends to be, you know, predominantly towards capital markets. So we borrow NCDs and commercial paper. That's the majority. We also have term loans from banks. That's another good chunk. And then, of course, we are a deposit-taking NBFC. So we have 12 to 15% of our liabilities coming from deposits. So that's the broad liability mix. And as you rightly mentioned, given the rate hikes, we've seen sort of a natural increase in our borrowing costs getting transmitted. And so what we have to be smart about, I think, looking ahead is plan for a return to the pre-COVID margin levels. I think the excesses, if I can say it, that over the last couple of years that the globe has seen in terms of just money printing that happened globally that found its way here, provided a little bit of a...
Oops, okay, I think there's some issue with your audio, but we will leave it at that. Thanks a lot for joining us and giving us an update. So that's, I mean, it's reflected in the stock as well, right? Just pull up a 3-month chart of Sundaram Finance. The going has been very good. It's been in excess of 20%, the gains on the stock. And the company says that demand is picking up in a big way. And this is the start of an upcycle, a multi-year upcycle in the commercial vehicle sector. Let's slip into